Hello everyone, welcome to our Egyptian online seminar group. First, second group, then if any questions you can ask our speaker during his presentation or after his presentation. I have great pleasure of welcoming the Professor Alan Sangster. Alan Sangster is one of the top accounting thought leaders in the world. He is a professor of accounting history at the University of Aberdeen and editor-in-chief of Accounting Education. He has been published more than 100 papers in top ranking journals, including the Accounting Review, Economic History Review, Business History, Accounting History Review, British Accounting Review, Abacus, and Accounting, Auditing, and Accountability Journal. Issue in Accounting Education, Journal Accounting of Accounting Education, and Accounting Education. He has received many awards, including the American Accounting Association's Outstanding Accounting Educator, the BAVA Outstanding Contribution to Accounting and Finance Educations Award, the BAVA Lifetime Achievement Award. Now we will start our seminar with the Professor Alan Sengest.
Thank you very much, Mohamed. I'm going to be talking for the best part of the next hour, and happy to take any questions at that point that anyone's got relating to anything I've said. I'm going to start by just point and then talking through it. So this is the title of the paper, so the presentation is all to do with stewardship, but there's more than just stewardship that I'm going to be talking about. And just to give you a bit of background, this is something I've been working up to over the last 15 years while I've been working in archives, looking at medieval account books, and it's sort of come together at this point. Everything's come together at this point. Now, I want to start by going into a little bit about the roots of the literature we've got, because one of the things that I've become very conscious of in the last 7 or 8 years is that the literature on the period, particularly before 1500, but also before 1800, about double entry accounting is problematic, to say the least. And I want to go into a little bit about how it came to be. The first person to really be recognized as an accounting historian was Fabio Besta, Italian professor in Venice. And he was really the first to do this. He led several of his compatriots, encouraged them, and developed the field. Now, one of the people that he influenced was Raymond de Roover, who was Belgian-American, published in the middle third of the 20th century. And he was very much recognized as one of the leading business historians, economic historians, and accounting historians of the medieval period. But he got his ideas, his original thinking, from Besta. In complete contrast, our literature is influenced by Werner Sombart, who was a German economist who in 1902 wrote a book in which he linked double entry and capitalism, saying essentially that without double entry, capitalism couldn't really exist. And he influenced, in his turn, Basil Yami, who is a South African Englishman, who was an economist. And it was de Roover and Yami that really established the English language accounting medieval and early modern accounting history as we know it in our literature. And one of the strange things about this is that the two of them are diametrically opposed in some of the things they believe. The photographer there got Basil Yami just coincidentally is looking to his right and de Roover's looking to his left. I suspect that's how they would have looked at each other in real life as well, because they were both very aware of their own abilities and very dismissive, in my experience of, and according to others, of other opinions that disagreed with them. Now, Besta looked at the period of Italian accounting history from 1200 to 1500. And his focus was on the account books. Raymond de Roover's focus was exactly the same, except it was more European. Yami, on the other hand, looked from 1494 to 1840, so it's a different period with only a tiny overlap. And if you look at the top left, Besta's focus was on assets. His view was that double entry should be used to manage your assets. If you look at Sombart, he took an income focus. So his view was that double entry should focus on the income. And that was the same view that de Ruyter took and Yami took. And de Ruyter took that view on income despite being strongly influenced by Besta. As I said before, de Ruyter and Besta looked at account books. Yami, on the other hand, looked at textbooks. So there's one reason why de Ruyter and Yami wouldn't have agreed about things. And in fact, they really didn't agree about textbooks. Twice, de Ruyter told Yami in print that he should be looking at ledgers, of which there were many available in the 16th century, if he wanted to look at the period after 1500. But Yami's response was essentially that textbooks are better than ledgers for discovering what people did. And that was never resolved, that debate. Now, one thing that typifies all three of those historians is that they were antiquarian. They described what they saw. Occasionally they would speculate. de Ruyter would speculate. Basil Yami would speculate, but it wasn't founded in anything very much, and they didn't pursue it to the point where saying that's what that was. So really they were just antiquarian, very descriptive in everything they did. And that is the flavor or the way that accounting history in the English language progressed thereafter. And in fact, the Italian literature on accounting history in the first half of the 20th century is the same. It's antiquarian, it's just describing what's going on. So no one actually really considered why the bookkeeping was being done. And that left a huge gap in knowledge and understanding, which I'll keep coming back to. What I'm going to be doing is addressing just one of the problems in the literature, of which that's a symptom. Others are described and discussed elsewhere, and I'll be talking a little bit about what's in this book that I've written that's coming out next month, and this book that I've co-written, which came out this week, and I'll be covering both of them later, but they cover different aspects from the ones I'm talking about today. But I want to point to some of the other issues that are being raised at the moment in the literature of accounting history. This article I published recently this year was about problems that are caused in the literature because people believe the literature. We believe what we read. And when we read something and we then use it ourselves, if that thing was a myth or a mistake, and we use it ourselves and build on it, it's like a multiplier effect. The mistakes get bigger and bigger and bigger. The myths get bigger and bigger and bigger. And the paper talks about things like that. And a completely different tack. Mike Doran published this article in the summer, a couple of months back, saying, can we stop calling critical theory history? Now, this relates to what happened in the 1980s. In the 1980s, there was quite a fuss in the literature about the quality of accounting scholarship in general. It was criticized as being descriptive, acritical, wasn't critical at all. And this is all across accounting. But accounting history was picked out for special mention as being almost entirely descriptive and therefore not very useful, helpful to anyone. And the response to that was that accounting historians did not become critical. They didn't start questioning why things were being done. But a group of them decided to adopt theories from social science, which gave them, if you like, ready-made explanations, if they could match the explanation to the artifact or the evidence they were looking at. And they became very successful at doing that, picking theories from Foucault-Bourdieu and matching them to what was being evident in what they were looking at. But the thing they don't do, these new accounting historians, is they don't look at everything. They will ignore evidence that isn't relevant to their theory. They'll ignore context that isn't relevant to the theory. So as a result, they're not what a historian, a pure historian, would recognize as doing history. critical history. And that was Mike Doran's point. They call themselves new accounting historians, but they're not actually doing what historians would recognize as critical history. And that's created a bit of a fuss that is going to develop into, I'm sure, conference debates and articles in journals, because there's quite a large volume of people that are doing it. And the other thing about the new accounting historians is that because they started doing critical work, their history publications became separated from the traditional accounting historians. They call it the antiquarian ones, the descriptive ones. And the descriptive antiquarian research became second class. The better journals wanted the more critical stuff, so they started publishing anything with a theory in it, to the point where journals like AOS, you can't get in it unless you use some critical theory. And that's the way the system's going. So essentially, it's resulted not in accounting history getting necessarily better, it's resulted in it getting less respect, I suppose you could call it. And the third thing I want to point to is that because of the situation where the traditional antiquarian accounting historian can no longer publish in the top journals, Martin Persson and Bon Radcliffe have put together an article also published this year, which gives you a roadmap as how to publish in the top journals based on accounting history papers that have been published in top journals, to show that there is a way to do it, even if you don't embrace all these theories. So there are changes going on, there's debates going on, and this is not a community that is in any sense settled about what it's about, what its focus is. Right, in accounting history literature, there's a big problem with terminology just generally, and that we cannot assume that terms we can define, that a term we can define is defined in the same way by everyone else. And I'll give you some examples. If you take these two terms, are they the same? Do they mean the same, or do they mean something different? To some people, they are the same thing. To other people, they are completely different. These two terms, some people think they're the same, some people think they're completely different. And if you take these terms, all of them, all five of them, they're all problematic. They've got multiple meanings that people will believe in strongly and defend strongly against those with different meanings for the terms. And one problem that comes that's related to all this is that in accounting history, you will rarely see any definitions of the terms used. So when someone says double entry bookkeeping, that might mean one thing to one person, one thing to someone else. If someone says stewardship, it means one thing to someone, something to someone else. So it's double entry, it means one thing to one person, another thing to someone else. So you can't really be sure what you're actually reading about when you're reading the articles, because you don't know what it is that they're actually focusing on in the articles because they have not defined it. And that's a real problem in our literature. And compounding it, translations do not always work. And I'm going to show you an example that ends up going into stewardship. Now, if you take, here's a really extreme example. The Portuguese language is a word called saudade. In English, there is no translation. There's no direct translation. In English, there's the word stewardship. And in Portuguese, there's no direct translation. So you can't talk to someone and just translate the words. You've got to do more than that. We cannot therefore assume that a term we can define is defined in some way by someone else. And even if they do define it the same way, maybe the words they're using mean something different to them than they do to us. And that brings me to stewardship. So what does stewardship mean? I know what it means. It's one of the first complicated words I ever learned. I don't know why that was. It was maybe because of my upbringing or something that was mentioned in the house. I don't know, but I've known what this word meant when I was in early school days. If you look at double entry accounting systems, they're structured and designed to produce financial reports. I think we'd all agree that's what's happening, what happens. And the preparation of these reports is guided by the conceptual framework. In 2010, the IASB and the FASB refused to define the term stewardship because it was too difficult to translate. They refused to use the term in the framework. Now, if you look at the definition in English, here's an American definition on the right, an English one on the left, a British one on the left. They're essentially saying the same thing, but the American one is more detailed. This is what, to me, stewardship is. And yet, the IASB couldn't agree on it, and the IASB and the FASB together couldn't agree on it having a meaning they could happily disseminate. The IASB reintroduced the term stewardship in the 2018 conceptual framework, and you can read a quite nice short summary of that in this article published in 2023, which is available online. And what basically happened is that in the 2018 conceptual framework, it says that general purpose financial reporting is to be useful for existing and potential investors, lenders, and other creditors. I mean, most of us already know that. And this would encompass other objectives which have been discussed in the literature, like valuation usefulness and stewardship usefulness. Now, valuation usefulness refers to the things that you need to calculate in order to work out future cash flows, allows you to therefore estimate the value of a company, and it's used by capital market participants. Stewardship usefulness refers to the usefulness of accounting information to encourage managers and employees to measure their performance, which is quite broad. But when you look at what the conceptual framework has done with it, it's made it very focused on the overall situation where the people looking at the annual reports, financial reports, can take a stewardship view on how well the management has used the entity's economic resources. Now, that's very much the highest level. It doesn't help very much knowing whether the entity managed to do well with use the resources at a lower level quite well. All it's got is the big picture, the one after everything's been consolidated and combined into numbers that represent hundreds of different numbers combined together. So the double entry accounting systems are structurally designed to produce financial reports. I'll come back to stewardship later. Before financial reporting, what was double entry accounting used for? Now, I say that because financial reporting really emerged in the 19th century. It didn't exist as we know it before then. And one estimate from Basil Yami was that it really only became, in any sense, widespread towards the end of that century. Before financial reporting became, again, something people did, double entry accounting was used, but there were no existing potential investors, leaders, lenders, creditors, no capital market participants for whom financial reports were provided. So the top level stewardship as embraced by conceptual framework was not relevant. Not only that, the focus of the capital market participants is also irrelevant. So it was used, therefore, for different things. Must have been for a different reason that promoted its use. What does the accounting history literature tell us about what it was used for? Absolutely, almost nothing. And if you read the accounting history of period before 1800, the accounting history of double entry, it has no clear view. And because there's no clear view, there's no understanding. And that's compounded by the fact that the literature doesn't include questions of why it's done. It's there. So if you want to understand the accounting history, I would say you need to ask why. And the only way to get the answer to that question is to look at the context. And if you ask why something's being done, why a record was made, take that requirement together. In order to answer it, not only do you need to look at the context, you need to know and understand it. So here's an example of how you can do that. And I'm going to focus on something that I've spent a lot of time looking at, the mystery of the origins of double entry accounting. For between 100 and 150 years, accounting historians have written that they didn't yet understand where double entry accounting came from, where it emerged from. And you can see that as recently as 2022 published in a book about the subject. Now, the reason why no one knew is because no one had looked at the context. When I went beyond that and started to look at the earliest example of double entries, which is in this extract from 4 pages of a ledger from May 1211. What I did was I focused on the context. And when I focused on the surrounding context for why these, which might explain why these entries were made, I found an answer to it, and I wrote it up in this article that was published in print this year. And what I found was that there were business risks at this time, with problems of shortage of coinage, multiple coinages as well, potential lost trade because there weren't enough coins to pay for the volume of trade. Therefore, people adopted credit, and because they adopted credit, they incurred debt, and debt could be defaulted on. So you needed a record to prevent loss from the debt default, which is where the beginnings of keeping a record came from. And then you had some protection to make sure that record had any value. So you had a legal system, and it developed to give the protection. And the entries that were made in the records contain all the information we expect in the double entries. And that's where the double entry system, if you like, began or started from, that sort of environment. Now, all of that you see on the screen was drawn from the context. There's nothing at all in the ledger, and yet it was only in the ledgers that the accounting historians have been looking for the last 150 years for an answer to that question. But as soon as you start looking at context, you begin to get explanations that can make sense. So what was happening when that took place? And I'm moving from here towards the sort of accounting they were doing, but I'm doing it in stages. The people who were running the place, running northern Italy where this took place, were the merchants and money changers who were in charge of the communes. And they created an environment where they prospered. And what they created, you can find it from the literature if you read it, the economic history literature, the history literature, the sociology literature. You can gather information from there, the legal literature. On the left is the environment they created. They got a legal system that was created for commercial activities. It didn't exist before. You've got an educational system which was designed to give merchants the mathematics they needed for their business. And they had multiple currencies, multiple weights and measures, variable values of gold and silver. They needed mathematics extremely, a great deal. The colonies abroad for their distant trade, where merchants from the same place would get together and they would organize agreements with the locals, which gave them discounted rates, preferential treatment, and security. The business networks they established across Europe and the Middle East where they traded. They had a cooperative culture, so they helped each other. They didn't compete in the way that merchants today compete. There was a great deal of trust between them, and they developed technologies. This is all between about 1150 and 1300. They organized a system of record keeping that included double entry accounting. They organized banking, clearing at the end of fairs that made the big trade events work. Nostra and Vostra accounts, which allowed agents, them to manage agents at a distance. Monies of account that enabled them to manipulate the currencies that they had available to them in the context of the changing values of gold and silver to which the currencies were linked, so that they got the values right in their account books. Communication networks, so that they could send messages to each other. Postal services, they could send written messages to each other. Bills of exchange, so they could make payments at a large distance, and letters of advice that told their agents at a distant place to expect a bill to be presented. And insurance, they did all that within 200 years. And that's the framework of the environment from which double entry emerged, or was part of the things that emerged. The merchants and money changers were the bookkeepers. They developed double entry. There were no professional bookkeepers at that point. They were their own accountants, and they developed the double entry accounting to serve their business needs. So their accounting systems were designed to give them what they needed for their business. But if you read the accounting history literature on this, it denies that any business need was meaningfully served by use of double entry until it was used to create 20th century profit and loss income statements and balance sheets. It is written in our literature that use of double entry accounting before then was pointless. And that's the overwhelming message you get when you read it, or I get when I've read it. And that's a mistaken view that emerged because accounting history has no clear view of its pre-modern past, which is mainly because, and this is a big problem, because of a definition. The definition adopted by accounting historians demanded that all double entry accounting systems of all periods were designed for that 20th century purpose. And those that didn't serve that purpose were declared not to be double entry accounting systems, and they were then ignored. So if the accounting system wasn't designed to produce financial reports or to be capable of producing financial reports, it wasn't double entry, as according to our literature, which is completely and utterly illogical. But that's the way the accounting history literature has developed over the last 100 years. This is a literature, or one version of it, and this is the one that people would probably cite if they had to cite one. And it's from Raymond de Roover in 1956. 3 parts to it. First part, all transactions recorded twice, once the debit, once the credit. Second part, you have to have certain types of accounts involved, real accounts and nominal accounts. So you've got to have assets, liabilities, income and expenditures. And the record changes in the owner's records, changes in the owner's equity, and permit the determination of profit or loss. If the accounting system had those characteristics, all of them, de Roover would say that's double entry bookkeeping. And so would everyone else. But the first requirement dates to the mid-14th century. Before the mid-14th century, double entry was done with the debits and credits above each other, above and below. There was no left and right. So this definition eliminates 150 years of double entry bookkeeping as not being double entry bookkeeping because it's not left and right. And the final statement is a modern business need from the 20th century. There was no need to have these changes before we had financial reporting. So the definition is just inappropriate. It assumes that the reasons for using double entry is always the same. It's the reasons used by joint stock companies. So when a joint stock company in the early 20th century said, we're going to use double entry, all other businesses should have been doing the same, even though they weren't joint stock companies. And they should have been doing it for 800 years or 700 years. The definition ignores the fact anyone could use the double entry method. And they're not all trying to make a profit. So you've got household charities, religious institutions, governments. They were all using double entry in the 13th century. Sorry, in the late 13th, early 14th, mid 14th century. So the definition of double entry was informed by what double entry method was used for in the 20th century by one form of entity and no other. Not what it was used for before modern times. Its use was ignored. And doing so created a literature that looks for the wrong thing in the wrong period and the wrong context. So it's no wonder that the accounting historians and the accounting history literature is not able to really understand or explain too well what was happening and why it was happening. The definition that they use breaks the first rule of historical research about avoid being present-minded. It is incredibly present-minded. And it's also an example of confirmation bias when applied in the way it is as a filter. By saying anything that doesn't comply, I don't believe it. So what was double entry accounting used for before modern times? Accounting history doesn't know, as I've said. The method that I adopted in this was to look at the evidence in its context, to try and identify what was being done by looking at real accounts and looking at what they were being used to do. Those needs were not established before I began. They were identified from the evidence and the context, just like the origins, that one I did with the origins of double entry. Then an appropriate term was identified to describe them a posteriori, i.e. at the end of the study. Pacioli's original definition of double entry was what I used. Now, this definition has been completely ignored by the literature, despite Pacioli being the main source for anyone writing about double entry history. It's in chapter 14, and what he says is each transaction is recorded as once as debit and once in credit. Each entry indicates the location of the other. That's the double entry method. I'll just say at this point, he does mention left and right, but that's the 14th century. Sorry, that's the 15th century. By then, everyone did it left and right. But the method itself, you don't need that. And then he said, these links chain together all the entries in the ledger. And that's his accounting system. So he's saying, you've got a method of recording your transactions, And the way you connect the entries to each other defines the accounting system that you're using. And following that through, if you follow the logic of these links, you'll be able to determine what the accounting system is trying to achieve. If we consider the facts by looking at the actual account books, the ledgers that exist, we've got 3,000, over 3,000 from before 1500. We've got 2,000 from the period of 1500 to 1600 alone in Italy. Never mind everywhere else. In none of these cases can you find profit and loss, income statements, or balance sheets of the form of the 20th century. Not in medieval double entry account books, early modern double entry account books, or in the manuals, the textbooks that Basil Yami was looking at. De Rover's 20th century definition was never going to make sense if applied to pre-modern times. So what was double entry used for before those times? Well, if you look at the facts again, take Pacioli's definition and do what I was saying and look at the accounting system, that should tell you what needs were being served by the records. And if you do that, you discover that they were all using something called venture accounting. It's in our literature. Basil Yami talked about it, but he gave it a different term, used a different manufacturing accounts, he called it. I think that's what he called them. But anyway, he didn't use the terminology the economic historians used. So the connection between our literature and their literature was lost. But they use venture accounting. So no accounts for sales, no accounts for purchases, and no overall inventory of goods. Can you imagine trying to make an income statement when you've got no account for sales, no account for purchases? What do venture accounts provide? Well, venture accounts provide a lot of information. They give you the data about everything that the business gets involved with, separately from everything else. All the direct costs relating to a venture, all the revenues relating to a venture, and all the other details that are considered relevant. And it's easy to calculate the profit and loss in each venture. Now, you might be thinking, well, a venture is obviously some sort of project. No, it's not. The venture accounts are absolutely everything. Merchandise, accounts for merchandise, accounts for voyages, journeys, finance, debtors, creditors, indirect expenses, even cash can be considered a venture account. Why? Because in each case, you want to manage them. You want to manage your merchandise. You want to manage your silk cloth. You want to manage your cotton cloth. You want to manage your wheat and your barley. You want to manage the journey that you're investing in. You've got to control. Example of a venture account. This is from the 15th century. It's from a ledger of Giacomo Badoer, who was a Venetian merchant based in Constantinople, which is modern-day Istanbul. That's extended so you can see the layout a bit better. This took out about a third of a page. And you can just, by glancing at it, you see there's lots of data. But here it is in English. And it's for scarlet velvet of the first quality. You got the details of how it arrived in Constantinople, who took it to Constantinople, what that cost, incidental costs relating to its delivery to you in Constantinople, where it originated from, what that cost, what its original value was, the cost of transporting it from the boat to the warehouse or the home, the brokerage fees, warehouse costs, broker's commission when it was sold, and the profit and loss obtained when it was sold. That's all on the debit side. On the right-hand side, it's got all the details of the sale. So anyone wanting to manage that account can see at a glance what's been going on. They can see whether they've paid too much to the priest for a docket, whether they've paid too much for brokerage, whether they're paying too much for the carriage to the warehouse, or they've paid too much for the commission to people at some stage. It's all very obvious what information is available. Now, if you imagine that you're acting for someone in a foreign place, and this is your ledger account for that person, you send that person that account to say, this is what I've done. They can then check the entries in the account you've sent them to ensure that you're actually doing your job as their agent. Double entry venture accounting systems. You think about them, you know what they are now, but what business needs do they actually serve? Well, if you think about it, what use would that type of accounting be to someone running a business? Ask yourselves these questions. Are costs useful to know? Revenues useful to know? Profits and losses useful to know? Are these useful things to know at any point in time about a venture? I think, do you think a venture account might be able to help someone manage the venture? Or someone who's delegated to manage it? Or someone who's managing someone delegated to manage it? Or a sedentary merchant who's delegated agents living 1,000 miles away who are managing the sedentary merchant's ventures? Surely that would be of some help. And then on the other side, does knowing the overall profit and loss of a business help a merchant decide what ventures to engage in? Because the accounting history literature would say everyone's keep doing double entry because they need to know their profits. So does knowing the overall profit actually help? And we've got two situations here. There's great certainty about markets. We could say that's more or less what it's like in the 20th century. You knew a lot more about your markets. You could be more sure about what might work, might not. But what do you do when there's no certainty about markets? Is the profit that you get on a venture of any use whatsoever in that respect? Well, it's not. It's absolutely no help. And there was no certainty about markets before modern times. So by thinking that the profit or loss in a venture would be helpful to a medieval or early modern merchant, accounting historians have completely ignored the context. There was no certainty in the markets, so you couldn't make use of that information. There was also no certainty about anything not physically present, which meant if you wanted to prepare a balance sheet, you would struggle to know what numbers to put on it. The international wholesale merchants before 1800 had no means to accurately know their current financial position or what their periodic profit was. It was impossible. They could calculate their profit or loss crudely based on the numbers they had by subtracting opening net assets from closing net assets. And that is really what the most they could do. But they had no need for double entry accounting to do that. So the whole suggestion you'd use double entry accounting because you wanted to calculate the profits of an international wholesale merchant business in the 16th century doesn't stand up to scrutiny against the context. However, there were exceptions. Tuscan partnerships that surround Florence, the state surrounding Florence, they did calculate overall profit or loss in the medieval period because they had partners and they had to distribute profits. Partnerships were short-lived, 3-5 years. And at the end of the period, they distributed everything amongst the partners and then just turned it over and started a new business out of what was left. It was a very crude calculation. It resembled a liquidation statement. It's been described as like that in the economic history literature. It was not why they used double entry accounting. It was simply a byproduct of the system. By closing the ledger, you were able to get numbers that you could agree on and spread between yourselves. And similarly with the East India Company in the 17th and 18th century, they used double entry accounting, but they never used it with any emphasis on using it for profit calculation. Profit was more of a balancing figure, and again, very crude. And it wasn't why they used a double entry accounting system. They had a lot of ventures that were very costly that they had to try and manage. And they had a lot of involvement in bills of exchange, so financial ventures were very important to them. This is an EIC stock per computation report from 1772 with the liabilities on the left and the assets on the right. Down the bottom right, you've got some notes about some of the assets. Take them away. That's the balance. This is their balance sheet. This is their report. This is what they gave anyone that wanted it. You can see the retained profits and you see share capital. They're not even combined into equity. The people that received this could see what the company had made that year. They could look at the previous years and work out how much could have been made this year by subtracting one from the other. And that's as far as it went. And it was so unhelpful to the people interested from an investor's point of view that 11 years later, in 1783, they were forced to go and do a much more detailed report. That had a lot more information in it. But it's still, because they were involved in venture accounting, and because we're doing long distance trade, they still couldn't produce numbers that really stood up to investigation. Now, if you look at the facts presented in account books and other records, double entry was adopted for a purpose, and you can see what the purpose was from what it's been used to do in the accounting system. It's used to manage debt, to manage agents, and you can confirm the management of agents through other records that have survived of business correspondence. When the merchants of northern Italy became sedentary in the probably in the 12th century and started using agents, it was a new risk to business, and they had to manage that risk, manage the agents. They also began to trade where commercial law did not exist, whereas in northern Italy it had started to develop from that point on. But the double entry record gave information of what the agents did, and that was the key thing. So they could manage their agents and compare what they were sent by the agents against the records that you could see from other agents, other merchants, from manuals and correspondence. Double entry is used for banking, clearing, bills of exchange, identifying costs and revenues in venture-based accounting system. It was used for a lot of things within a business. And you can see the accounting systems focusing in on each of those in ways that would help. They focused on assets and liabilities, not profit. Assets and liabilities were what Fabio Bester focused on. But De Rover, Yami, and all the accounting historians from 1920s onwards looked at profit. Accounting was for survival and doing as well as possible, not profit. It looks at debt, agents, offset, and clearing. But there's no evidence double entry was used because anyone wanted to know the overall profit before 1800. Net profit was a byproduct, not a goal. And who was using it in this period? Well, the same ones as were using it in the 14th century. They just kept using it. Charities, household, governments, banks, merchants, and partnerships. But it was the profits that came out of it were always a byproduct. The main thing they were all trying to do with the double entry was manage the business. It was stewardship. So double entry accounting was used up until 1800 to manage the assets and liabilities and those responsible. That is stewardship. Absolutely how in the English language we define it. That is stewardship. So that was the purpose of the role of double entry. It brought efficiency, systemization of the record keeping, completeness, greater control, reassurance. And it gave you the ability to be efficient in your credit trade, your banking, your clearing, your bills of exchange and agents. It gave you a level of proficiency that you wouldn't otherwise have had. It made possible what was achieved before 1800, and it created a foundation upon which modern capitalists built. So they took the business acumen that had been developed over the 700 years and converted it into joint stock entities and developed the expertise forward. And double entry was so established that it created a mystique that allows an accounting profession to exist. The only reason the accounting profession exists is because we have the expertise in double entry. Everything else is just something added on. So it gave us that. So unlike the accounting historians or definition of double entry bookkeeping, where the modern definition comes first and acts as a filter, this investigation I did began with the original definition from the right period, did not begin with a definition of stewardship, did not assume stewardship. Stewardship was what was found, and it was the conclusion of the study, not the beginning, and it was found because of the comparison with the evidence to context. Why did accounting historians never reach this conclusion? Surely at some point they must have twigged that people weren't doing financial reporting, and that therefore it was pointless looking for it. Did they just see double entry as a tool, which is like a one-off, or is it just technology, or is it a technology that has multiple uses? Which did they do? Well, did they see it as something mechanical, not scientific, not interesting, boring? A method only used because the most efficient bookkeeping method to produce financial reports. Something done to impress because other people don't understand it. Something rhetorical, which is used to convince other people of your ethical behavior, ethical performance, or whatever. Well, those are all to be found in the literature on accounting history over the last 40 years. They've all been proposed in one way or another as reasons why people use double entry, but none of them come from the context. Going back to this about did they see double entry as a tool or a technology? One very big result of this, of seeing it as a tool, which is what accounting historians have done, as something used just for one thing, one purpose, is that business historians have heard this message. They've heard that double entry is only used historically for financial reporting. And the accounting historians, through this focus on the financial reporting, have belittled the flexibility and power of their own technology and dismissed its status and contribution to the organizations who used it. So if you try and convince business historians that double entry served any useful purpose to business before 1800, it's almost impossible, because they've read the accounting history literature, which says double entry is not worth using it unless you're producing financial reports. So it's actually backfired on us as a discipline, this approach by the accounting historians. And it makes accounting historians find it very difficult to publish outside accounting history. For more discussion of several of the points mentioned, I'm just going to conclude by covering a few points. This book of mine that's coming out next month has 4 sections in it, chapters in it, if you like, which are relevant to what I'm talking about and go into some of them in some more detail. The preface, which is about definitions, the introduction chapter, the primer chapter, chapter 2, and then chapter 11 about problems. So you get more about this if you have a look at that. And from a very different perspective on double entry accounting, one that actually makes me wonder what on earth was going on. This is a critical translation of Ludovico Flori's treatise on household accounting for the Jesuits. It was published in 1636. It was published on behalf of the Jesuit order in Sicily, written on behalf for them, and it was used throughout Sicily. It then, by the 1660s, within 30 years, it was republished in Rome and used by the Jesuits in the rest of where they were located. And it sets out how to maintain the accounting system, the accounts in double entry for stewardship. Now, this is the contents. I just want to draw your attention to something here in the contents. And the book begins with basically a summary of what Flori said. If you look at items 12 and 13, item 12 is the accounting policies that he introduced in 1636. A value for self-grown produce, that is standard costing. Inventory revaluation of goods held for future sale, that's accrual adjustment of asset values at the end of a period. Matching into income to expenditure, because they did that because they wanted to line the income and expenditure up to the manager responsible for them, the steward responsible for them, so that person would be held to account. And they had prior period adjustments to make sure that everything was aligned properly, even if it was done after the fact. And they also used the double entry accounting system for forecasting future costs, future revenues. And this was in 1636, a long time before accounting history thinks it was actually first done. Double entry accounting system for non-profit entity, that's what this was. It prepared financial statements, which the accounting historians were looking for. It actually prepared the very statements accounting historians were looking for 100 years, and did it in the 1630s. Remember, it's not a profit-making entity. This has never been acknowledged in the accounting history literature because it's a literature about merchants and banks. And Raymond de Rover warned accounting historians in 1956 in a chapter published by Yami and in a book edited by Yami and A.C. Littleton, that there was too much focus on merchants and banks and we should be looking at other entities when no one listened. This is the income statement. Those 2 columns of the income statement. On the right are all the gains and losses, or all the gains from using standard costing for the pricing. The bottom left, you see the total for the general expenditure of 2845 carried forward to continue it to get to a final total of 4016. that expenditure, and you got the income above it. When you subtract one from the other, you get the 1325, the net income at the bottom. That's your income statement. And this is a balance sheet. There's your net income carried forward from the previous statement. And here's the two columns for the balance sheet. The left-hand column is your inventory, and the total inventory is carried forward to the current asset list on the left, and on the right are the current liabilities. And if you take the balance shown on the debit side of 3765, that gets transferred into the equity account, if you like, the capital account. And if you look at that, the statement of changes in equity, I've called it. The first credit entry is the balance from the previous year. The second credit entry is the income, net income for this year. The first debit entry are the prior period adjustments. And then finally, you've got what remains from above. So there's a balance sheet and an income statement, 1636, containing the information that the accounting historians were looking for in banks and merchants and couldn't find it. That entity was not allowed to trade. The Jesuits weren't allowed to trade, and there are actual ledgers that have survived from that period in Sicily that accounting historians have looked at, but they've never looked at why they are there. They've just looked at them and described them. It was not allowed to trade for profit. The role of double entry was entirely stewardship, and the theme throughout the text is stewardship, managing assets and liabilities and those who manage them. It used venture accounting. It knew what assets and liabilities were. It actually knew them. It didn't have to worry about them being at a distance. It applied appropriate values to its assets. It matched income to expenditure, etc. It was consistent with the definition the accounting historians use. So the 20th century definition actually works with this 1636 entity, but it's not a joint stock company. This example of a need for financial reports had nothing to do with economic decision-making, capital markets, investors, or creditors. The report served a stewardship need because the Jesuits wanted to know if each house or college was being well managed. So each house or college had to prepare these reports, and then they were audited by the Jesuits to see whether the person in charge was doing the right job, and then the person in charge was monitoring the people below him. So it's all about stewardship. And then if you look at all of the other ledgers and account books that have survived from the period from 1200 to 1800, you'll find those that are using double entry are using it for stewardship. Their accounting systems are focused on stewardship, not on preparing reports. And that's what drove them to use double entry, because it encapsulates all the data that you need to do the management. So does all that matter? Does it really matter to us that the accounting history has missed it, that it's made a mistake? We've got the issue about how other disciplines view accounting history or double entry as something that might be useful. That's certainly a problem. But it matters in other ways as well, because our literature is incomplete. It's very incomplete. We know factually what some people were doing. We have no explanations for what they were doing. We've not looked at it. So there's a great big hole in what we actually know about accounting and its history before the modern times. So where to next? Well, there's various things that people could do to try and sort this out. You could look at what double entry accounting systems were designed to serve in different entities in that period. Build a new literature double entry before 1800 to replace the current one. Focus on being critical accounting historians, creating a theory from the evidence surrounding context. Looking at revisiting the ledgers that have been dismissed as not being examples of double entry. Potential major misunderstandings that need to be corrected. Remove ambiguity by defining the terms we use. Make the literature higher quality. Stop using the term double entry bookkeeping, because that's just not transferable out of the 20th century. Use the term double entry accounting, and it deals with any instance of double entry. And work with people from other disciplines so the benefits of using double entry accounting can be more clearly defined and better understood. I don't know anything about manufacturing cloth, but if I'm looking at a ledger of a cloth manufacturer in 14th century Florence, and I want to understand what the benefits of using a double entry are, surely I will get some help from someone who's a specialist in the history of cloth making. I mean, it's things like that that we need to do. In other words, what I'm suggesting is, because it is evident that we don't know very much, we have an opportunity to go and start branching out, developing our expertise and our knowledge and becoming truly interdisciplinary using this database of thousands of account books that are available to us from 1300 to 1800, from right across Europe. And if we did that, then I think that we really have a potential over the next few decades to actually resolve the issues that have been created by our forefathers, if you like, and create a literature that's worth reading and worth looking at and gives us a lot of information and understanding about the importance of accounting in previous periods and makes us more acceptable and double entry more acceptable as a technology to those in other disciplines than it is at the moment. And that's me finished the presentation. So thank you for that.
Thank you very much, dear Professor Alan Sangster, for your contribution and your effort. It's really an excellent presentation. Thank you very much. Now, if anyone have any questions, you can, when you can ask your question. Professor Shyam Sand.
Thank you, Professor Sangster. It's very informative and extremely interesting talk. And I just want to mention a couple of things that came to my mind as I listened to your talk. In William Halo, who was a professor of Assyriology here at Yale, wrote about some cuneiform tablets in our collection at Yale Library, where he says there's a lot of evidence of use of double entry in our 22nd century before Christ. And second, according to an article by James Chan, there is in the Acropolis Museum in Athens, there's a stele which was found outside Parthenon, giving annual accounts of contributions made for construction of Parthenon and expenses for gold and labor and sculptors and so on, and the rates. It's all given there. Of course, the problem was that they had only Roman numerals to work with, and accounting with Roman numerals was not easy to do. And I believe Fibonacci's father went from Italy to Europe, into Libya in Africa in 11th century for trade, and Fibonacci grew up there and went to Libyan schools where he learned the Indian, or what you call Arabic numeral system and accounting systems, which they brought back to Italy. And that's why Italian practices change from 12th, 13th century. So there's a lot of history. I'm supporting what you said, that there's a great deal of history all over the world about this, but historians haven't really paid much attention to it because it's spread across many disciplines. Like Professor Halo's work is in journals of Assyriology and not in accounting journals. Thank you. I enjoyed your talk very much.
Thank you very much. Yes, I was aware of the writing on the Parthenon and the other things as well. It is interesting how people kept account. I was reading something the other week about Chinese. Someone was claiming that in the 3rd century Chinese government was actually writing or keeping records in double entry. And I think that's a bit like the cuneiform tablets. I mean, it may be or may not be, but
yes,
yeah, you know.
Yes, you're right. In Dunhuang Caves in far northeastern China, one of the caves had about 50,000 manuscripts, and quite a few of those manuscripts were actually accounts of Buddhist monasteries in that area. And the monasteries basically functioned, not only they ran their own operations, but they worked at banks to loan salt and oil and grain to the farmers and get it back, and they kept accounts of those. And that is from 4th to 8th, 9th century, yes.
Yeah.
Thank you.
Thank you.
That was a question. Anyone have any question? Yeah. So, Steven? Yeah.
Alan, I sure enjoy your talk, just like the summer in Chicago. This reminds me very much of Thomas and Kaplan's book, Relevant Lost, The Rise and Fall of Management Accounting in 1987. And that book is about how the demand for market-based information swamped innovation in management accounting, so that management accounting went through a dark period of about 30 or 40 years where there was no innovation in accounting because all of our energy, all of our resources were going into financial accounting. But this is the first time I'm looking forward to your book, by the way. I'm excited about learning more about venture accounting. So you're telling us that accounting was relevant in a time when there was no certainty in markets. And that's when double entry accounting came. Now we're told we can't account for intangible assets because they're so highly uncertain. So have we so painted ourselves into a corner in our public policy that we really can't free ourselves to do good quality accounting for things that matter?
I think every society goes through that phase of getting something perfected and then having little gremlins crop in, things change, and it becomes too clumsy to work out what to do next. I found what you said about relevance lost interesting because I'd forgotten about it. But when, if I just digress slightly, when Fabio Besta presented what he called asset theory in 1880, and the focus was basically if you want your accounting to be considered a science, you have to use the best bookkeeping method, and that is double entry. And the key thing you're going to be focusing on is managing assets. That was fine. For 40 years, that dominated Italian thought. Then in the mid-20s, Gino Zappo came out with income theory. And he said, no, if you're using double entry, using accounting, you're going to have a focus on income. And overnight, almost, according to some Italian colleagues I've spoken to, you found that businesses were no longer having details of their ventures. They were ripped out and were using sales and purchases accounts. And the level of granularity available to the management to run the business, the management accounting type level, had gone, totally gone. So essentially you had to reinvent, or you had to invent for the first time management accounting because the priority had switched to financial reporting. So you've got a repeat. So I'm glad you pointed that out. But I think in terms of unknowns, if it's not important to you, you don't need to actually worry about it. It's when you think something's really vital, really important, that you have to account for it. Now, for these merchants, what they did was they just organized everything around the fact there was unknowns. So they didn't know what value their consignments overseas were now worth. So they just ignored it. And they didn't try and fake or push together some artificial statement that said, here's a value based on our estimates, because they didn't need it. Made no difference to the business. If you have to make it, if it is needed, of course, you've got to try and do something. I think sometimes we try too hard.
Thank you.
Thanks, Doug.
Are there other questions? If anyone have any questions, you can open your mic and ask your question. Peter, have any comment or any question? Anyone have any?
May I?
Yes.
Hello, Alan. Thank you so much for this talk. It was just wonderful to hear you. And then I was here just wondering, because yeah, we see a lot of in the literature people saying all the time and repeating that the main purpose to have double entry bookkeeping or to have accounting is to calculate the profits, and then it's quite good when we use really things, evidence from the ancient books, just to prove them or to try to show that yeah, there is a kind of mistaken or misunderstanding. And then I just would like hear from you, because I think this is the main contribution of really research. Because even when we think something that everybody think that is normal, it's the way it is, and then you came across with evidence and prove another thing for everybody. And then yeah, so just to talk to hear from you a little more from this. Thank you so much.
You mean from how what we believe is found to be false and what we do after that? That's a real problem for accounting history, because we tend to rely on the a priori literature, the first literature. We tend to believe it, and we don't revisit it. So leaving aside what I've been talking about, it is a weakness in the accounting history literature that people don't tend to revisit, whereas historians will revisit. They'll go back and look at an artifact 60 years later because they now know a lot more about its context, and they'll discover brand new things about it. So, for example, you might find some tablets in a desert and you don't know anything about it. You don't know what they can possibly mean because no one's actually thought about this before. But then someone does with respect to other tablets, and you think, oh, okay, well, let's try that. Now that's 20 years later. So you're going from saying, I found tablets, no idea what they are. They've got some hieroglyphics on them. Now you can see, but we don't do that in accounting history. We just leave the past as if it's ring-fenced in our understanding. And that's a real weakness. And I speak a lot to historians of other disciplines and medieval historians of other disciplines, and their criticism of accounting history is unrepeatable at times. It really is. And they're not just talking about the medieval literature, they're talking about the accounting history they read, and they tend to read any accounting history up until maybe the 19th century quite comfortably. And they're not happy with the way accounting historians approach it. And I don't know exactly why we do the things the way we do, but we certainly don't do everything the way that historians do them. And I think that's a disadvantage to us as a group. This is one case where we should be doing what everyone else does, and then we will make discoveries of new interpretations that currently we don't make.
Are there other questions? If anyone have any questions, you can open your mic and ask your question. Yes, Kenneth?
Hi, thank you. A very inspiring talk. What you said about technology gave me an association to, or made me think of blockchain technology, which is a way of keeping track of things and making sure that nothing changes. If you change one thing, you'll know that the bottom line does not compute. So do you have any thoughts on this? I thought that was very inspiring, thinking of double entry accounting as a technology, not simply as a tool for one purpose. Thank you.
In what way do you want me to think about blockchain? I mean,
well, I thought just that's not, it's just the fact that you use a technology to make sure that whatever happens is true and accurate, so that you have control. It goes to the idea of stewardship, I figured. And so, everything is linked together, which was, it's not just the point that things are recorded twice, but it's that you manage to link everything together. So if you change one thing, it'll show up as an error. Things don't balance anymore, and there is an error, and so they can be discovered. In that sense, I was thinking about it.
Yeah, in that sense, there's certain similarity to it. Yeah, you certainly, if you miss out if you miss out the debit, then you're not going to have a trial balance that balances. But beyond that, there's not that much, I would say, that they have to do with each other. Although they can both be applied to business at the same time as they are, so they overlap. But it's interesting in a sense that here you have two technologies that have the same specific red flag symbol for one particular circumstance that could happen. But in double entry, it can easily happen. In blockchain, would human error give you this problem in blockchain, or is it something to do with the programming that would do it? I don't know. But yeah, interesting. Technologies, what you can do with them.
And one other thought, if I may, you mentioned that it started with credits. They were short of coins, so they needed to borrow. So in a sense, wouldn't you think that this sort of relates to the fact that it is actually a lending market that created the need for double entry accounting? In part.
It was a market based on credit. It wasn't a market that was entirely credit, because people could pay if they wanted to with cash. If the cash would be acceptable to the person that was receiving it. But what happened was that there was a shortage of cash, and that persisted for 1,000 years in Europe up until the 19th century. And the thing was that they had this, it would be a mini explosion in trade where the value of the goods coming in and the market for them was much bigger than it had been previously. And so previously, the small local markets could survive with the coinage that they had, and with local people knowing each other, they could get by with a little bit of credit. But suddenly you had markets where there just wasn't enough cash, and they had to have credit. And so the credit led to a record system that led to what we now call double entry. But yeah, it wasn't a credit market. It was a market that relied on credit.
Thank you.
Okay.
Professor Salvador, you have any comment?
No, I just I just put a comment on the chart, in the sense that in Spain, and Angelica is also saying that in Portugal, in Portuguese, the term which is already used is double entry accounting, contabilidad por partida doble, and not double entry bookkeeping. Okay, so we are already using that. Okay, just as a curiosity for everybody. Sorry.
No, I'm glad to hear it, Salvador, because it's sensible, isn't it? It's like the Italians wouldn't use it in Italian. They'd say partita doppia, and that's it. Double entries. It's very, very English language.
So where does accountancy come from, Alan? Big accounting programs in the US have schools of accountancy, not accounting.
When I grew up, accountancy was what he called the profession. I remember having a debate 40 years ago when I started teaching. One of my first lunch breaks with one of my colleagues who was teaching accounting and was my mentor, essentially. And she said, "Why did you call it accounting or accountancy?" And I said, "Oh, I call it accountancy." And I said, No. You have to use accounting. Everyone understands that. Don't use accountancy. Students get confused. So I don't know.
Good point.
There's another question. If anyone have any question or any comment, you can open your mic and ask your question.
May I ask, what were the reasons for shortage of cash? Was it the shortage of, because cash was linked to precious metal coins and there was not enough precious metals available? And it was that would have been like a gold standard in a way.
Well,
Or was there some other reason?
no, it was like there's always been coins in the last couple of 1,000 years. There's always been coins.
Yes.
But the trade, the volume of the transactions, the value of the transactions was an issue, because the volume of coins for the small markets was sufficient to a large extent. But the problem was the mints only started to appear in the get my centuries right, 12th century. The mints in Italy really only started to become widespread around about then, and the controls were a little bit light, so you had some scandals where sub-weight coins were issued because they were all meant to be linked to the value of the original silver as they were at that point. And there wasn't enough silver to mint all the coins that you needed as well. So the demand for the coinage exceeded the supply of the silver. They introduced gold coins because they had higher value, and they introduced them 1260s. And they had higher value, but they created other types of issues where you got people not speculating, but hoarding them because gold was in short supply and the price of gold kept going up right through medieval period. But people didn't want to use their gold coins, so they'd be taken out of the market. So it was a combination of everything, but basically the coinage did not expand at the same pace as trade. That's a big problem. And when that happened, you had to get a substitute. And there were odd attempts to do bill on issue, wooden coins and token coins, but they never really took off at any point in the period I'm talking about, in the place I'm talking about. It just wasn't a successful thing because people liked the gold and the silver, particularly the silver. It's all down to that. So the shortage of coinage, which meant that you just had to find other ways of doing business.
Now we have the opposite problem with paper money.
Yeah, well, yeah.
Is there another questions? If anyone have any questions, you can open your mic and ask your question. Professor Mikhail, you have any comment? If
I guess I
anyone,
have to ask one more question of my colleague, Alan.
yes.
So Alan, we talked this summer in Chicago. So I've been mostly ignorant of your work. I've been reading a lot of Jacob Saul to get my history, and lately I know Ray Ball is writing some accounting history, and Ray in particular just published an article in Accounting Horizons saying that double entry accounting came about because of markets, and as long as there are markets, there will always be double entry accounting. So I would assume that you wouldn't think too much of our Chicago school colleague on that assessment.
No, and on the contrary, I think he's right. I mean, okay, it was credit. It was the credit that was the problem. Sorry, the cash that was the problem, the coinage. But it was the markets where the trade was going on. And without the markets, there wouldn't have been double entry. And without the double entry, there would have been, well, markets generally, you've got a buyer and a seller. You're exchanging. And if you're going to keep a record of it, you're going to keep a record of what's happened. And if there's any credit involved in it, it's going to be a very detailed record, and it builds up from that. But I think Ray Ball, his approach, his hypothesis was okay as far as I'm concerned. I quite liked it because it at least acknowledged that this was something that came out of markets. And because you wouldn't necessarily keep a record of cash, it was something that was implicitly saying that credit was what was happening, but it worked for me. And it was a nice short piece, and I would recommend it to anyone who wants a little bit of an opportunity to think about something without having a lot of extra stuff hitting you. You might not agree with it, but at least it gives you an opportunity to think about it.
I liked his referencing of the Scottish Enlightenment and the natural emergence of certain institutions, and certainly markets emerged, as a result of the environment that you're emphasizing too, is that you have to know the context, you have to know what the needs were at the time. So
Well,
yeah, it's an interesting piece.
That's one of the things that I liked about what he did, because he was looking at context. He was actually trying to think about the context to bring it in, and that was refreshing. Good.
But Doug,
Thank you.
it seems to me that the term market is used in such broad contexts. If you go to Gary Becker, exchange between parent and child is a market, all the way to Bitcoins and stock market. Then everything becomes a market. When everything is market, then nothing is a market.
Mhm.
So I don't know what it means, unless market is defined at some finite level of liquidity. It is used in economics with such a broad known definition.
Absolutely. That's true.
I'm not sure. Thank you.
In other words, words you need to define. Yeah.
Are there other questions? If anyone have any questions, you can open your mic and ask your question. Thank you very much, Professor Aaron and Sangster, for your contribution and your effort. Thank you, everyone, joining us today, and thank you very much for taking the time to present to us today. It has been appreciated, Professor Aaron Sangster.
My pleasure. Thank you for listening.
Thank
Yeah,
you,
and
Mohamed.
yeah, thank you. And I hope to see you soon in Egypt. You are very, very welcome.
And thank you, Mohamed. Thank you
Thank
very much
you.
indeed.
Thank you.
Bye.
Mohamed, I'll stay around to the end.
Hello.
I'll have a word with you at the end, Mohamed.